Hello and welcome to MEPL Classes, everyone. My name is Rishi Jain and we are going to do CFA Level 1 Financial Statement Analysis. In last class, we did LOS 19, which was understanding balance sheets. So what have we done till now? We have understood what were the components of financial statements. We have understood the statement of financial performance or the statement of total comprehensive income. After that, we learned about the statement of financial position or balance sheets. And finally, now we move on to understanding cash flow statements. This is the third component of financial statements. Before moving forward, I would just like to tell you all how you can get MEPL Classes CFA course. To get the course, what you need to do is you need to go to meplclasses.com. Let me just show you how the website looks and where you can get our classes. So when you log into meplclasses.com, this is how the website will look. I hope that you can see. Here you can go to courses, and from the courses tab you need to select international courses. Under international courses you can select CFA, and from here you can see there are two options. The first option is to buy mobile, where you can view our classes on your mobile application, or the second option is the laptop version where you can see our classes on your laptop. If you have by chance made a mistake and purchased the wrong version, please contact our technical team. They will be there to support you. Now, before moving forward, everyone, please, if you like our classes, do like, share and subscribe to our channel and press the bell icon. This helps to motivate us a lot to give you the best quality classes of all professional courses. And today we will be continuing with CFA level 1. Okay, so I hope everybody is ready. Let us start. Understanding cash flow statements. So what are cash flow statements? I hope everybody remembers. So when we learned about the statement of financial performance and the statement of financial position, one of the most important assumptions and principles that we learned about was the accrual assumption. And what does that mean? The accrual assumption makes sure that transactions are recorded when they occur and not when actual cash flow takes place. So for example, if I am going to buy or sell any good, any fixed asset or anything else on credit, that is actual cash is not taking place. Let's say I buy this bottle from you and I say that I'm going to pay you 1 week later. I have already bought the bottle and it is in my possession. So the transaction has already taken place, but money has not yet exchanged hands. So does that mean we do not record it in our financial statements? That is what we learned. That is not it. We do record it on accrual basis. So in our financial statements, that is the statement of financial performance, we will be recording purchase of water bottle. And in a statement of financial position, that is the balance sheet, two things will come. The bottle will come in my asset, and the payable, the amount that I have to pay to you at a future date, will appear as a creditor or as accounts payable. So that is how we were recording transactions on accrual basis in our books of accounts till now. But let us understand something. I am a company and I am not being able to sell my products. I go to the market and start giving my product to everybody and say, please pay me later, 2 days later. I do not know anything about the people who I'm selling my goods to. I'm just selling this randomly just to boost my sales. So what is happening? In reality, am I actually going to get back the entire money from the sales that I have made? It might be that I do not receive any money. 90% of my goods that I have sold might not be recoverable. So in that case, the amount that I present in the statement of financial performance, will that be accurate? Obviously not. So what we need to understand is that cash flows is the lifeblood of a company. In the end, what matters is how much money you are actually making. So cash flow statements, what it tells us is how much actual money cash came to the company and how much actual money did we pay. It deals with only cash transactions. So cash flows, the cash flow statement of cash flows helps us understand how much cash came into the company and how much cash was utilized by the company without any accrual. So there is no accrual principle while we are preparing the statement of cash flows. Now let us understand. So this is the first page, and as in every class we have done, this is just the explanation of what the CFA Institutes expects us to know after we have learned this chapter. So we'll just go through this quickly just to get a gist of what is going to come in the chapter. Okay, so LOS A 20A, compare cash flows from operating, investing and financing activities and classify cash flow items as relating to one of those three categories given a description of the items. Number 2, describe how non-cash investing and financing activities are reported. Contrast cash flow statements prepared under IFRS and US generally accepted accounting principles. Fourth, compare and contrast between the direct and indirect methods of presenting cash from operating activities and describe arguments in favor of each method. Next, describe how the cash flow statement is linked to the income statement and the balance sheet. Next, describe the steps in the preparation of direct and indirect cash flow statements, including how cash flows can be computed using the income statement and balance sheet data. Next, demonstrate the conversion of cash flows from indirect to direct method. Analyze and interpret both the reported and the common size cash flow statements. And finally, calculate and interpret free cash flow for the firm, free cash flow to the equity, and performance or coverage cash flow ratios. So this is all that we are going to learn in this chapter. I hope that everybody is ready, because you do not need to remember this page. This is just like a table of contents for this chapter. So let's start. Our first slide for the day. What are the components of cash flow statement? So every financial statement had their own components. For example, when we learned about the statement of financial performance or the profit and loss account, we learned about the revenues, expenses, net income, other comprehensive income, total comprehensive income. All those form the components of the statement of financial performance. When we went to balance sheet, we learned about assets, which is equal to liabilities plus owner's equity. So that was what we learned in the previous two statements. Now when we come to cash flow statements, it is divided into three segments. The first being cash flow from operating activities, cash flow from investing activities, and finally cash flow from financing activities. So every activity which involves cash flow has been divided into three parts. Either it can be relating to the operations of the company, or it can be relating to investments or financing. These are the three items that encompass all cash flow transactions. So every cash flow that the company occurs can be divided into either of the three. So what is cash flow from operating activities? Let us start with that. So first, the cash flow from operating activities. The company is obviously involved in some sort of business. Every company is involved into some sort of business. So any cash flow which is directly related to the business of the company. For example, let us say as a tuition center, we are providing tuition services to our students. So the tuition fees that we are receiving is the direct receipt from our services, from our operations, that will be coming under cash flow from operations for us. The taxes that we will be paying to the government, which is in relation to the operations of our company, is a part of the cash flow from operations to our company. Any salary that we might be paying to our employees who are involved in the operations of our company, again would classify under cash flow from operations. So let us see the definition to get a better understanding. This provide information on cash flows that are derived from day-to-day activities. What are day-to-day activities? The operations of the company. Among others, these cash flows includes sale of inventory, basically sale of products, goods and services, provision of services, or other activities that are not relating to financing or investing. So basically what they are saying is that any activity which is not financing or investing is operating. So operating is like the trash can. If it does not classify under investing and financing, we can put it under operating. That is how it is written. Further, cash flows from operating activities also include cash receipts and cash payments arising from dealing or trading in securities. Now, one thing to make sure is that when securities are involved, that is shares, whenever we are buying shares of any company or buying debentures or any other form of securities, it might be either investing or operating. So we need to make sure that that what we are dealing with is an operating activity. In case nothing is mentioned, what is the best thing to assume? And that depends on the business of the company. So in the exam, you will be given what kind of business the company operates in. If it is written that the company is operating in manufacturing activities, it manufactures steel products and sells them to its customers. If such a company is investing into shares, what do you think? Will it be a part of its operations or will it be a part of investment of additional cash? I'm pretty sure everybody can guess that. This is a very simple example. In case the operations of the company is relating to manufacturing and the company is dealing in shares, then it is most likely that the dealing of shares and securities is relating to the investment activities. In that case, any cash flow that occurs due to investment in shares and securities will be a part of cash flow from investing activity. Okay, so I hope everybody got the gist of cash flow from operating activities. Let's move to cash flow from investing activities. This provides information on cash flows that are derived from the purchase or sale of long-term assets and other investments. Such ventures include the purchase or sale of property, plant and equipment, intangible assets, investments in the debt equity issued by other companies. So what does this mean? So this is where some people might get confused, because when we are buying property, plant and equipment, you will say that the property, plant and equipment are being used in the operations of the company, so it should come under cash flow from operating activities. But when we say cash flow from operating activities, that is directly attributable to the sales and it should be within 1 year. In case of cash flow from investing, when we are buying property, plant and equipment, we will be using that machinery over a long period of time, right? We are not going to use the entire machine on day one itself or during 1 year also. If we buy any machine, we expect to derive benefits over a long period of time. That is why depreciation is charged. That is why what we do is we allocate the cost of the machine over the life of the asset. So that is why we need to make sure that it is an investment, that we need to understand that this is an investment for the company. Any plant, property, equipment that the company is buying, even to produce its main good or to supply its main services, that would be classifying under cash flow from investing activities. Apart from this, if the company makes any investments, what does that mean? This means that the company has additional cash and they are going to invest the additional cash into debt or equity issued by other companies. So what does issued by other companies? Basically, the company is investing the additional money that they have into the share market. They're behaving as an investor. So that money will also be presented in cash flow from investing activities, because that is nothing but an investment for the company. Cash flow from the cash flow statement is pretty self-explanatory, so there is not much to understand in these components, but there's a lot to understand when we get into the details and the preparation of cash flow statements. So please be attentive today. Next, and this is the final component of the cash flow statement, that is cash flow from financing activities. Let us first read this definition. This provides information on cash flows that are derived from acquiring or repaying capital. Cash inflows would arise from issuance of stock, bonds, borrowings, while cash outflows would include cash payments for repurchasing stock, repaying bonds and other borrowings. So what does this mean? What is financing? Raising money, right? So when the firm or the company is raising any sort of money, what are the different options to raise money? They might issue new equity shares, they might issue new preference shares, or they might issue debentures, bonds. The company might take borrowing from banks, borrowing from financial institutions. All these are the different modes of raising money that the company has. And these activities are called financing activities. Okay. So any cash flow which is in relation to raising money should come under cash flow from financing. I hope we all are clear with this. So there are three components of the cash flow statement: cash flow from operating activities, cash flow from investing activities, and finally cash flow from financing activities. Let's move on and get into the details. So first and foremost, let us understand. Like I said, that everything related to cash should come under the cash flow statement. So what about items which are non-cash? You would ask, give an example of non-cash activities. Let us say that I converted my preference shares into equity shares. We learned about the conversions when we learned about BEPS and DEPS, that is earnings per share. When we learned about complex capital structures, that's when we learned about convertible preference shares, convertible debentures. So in those cases, are there any movement of cash taking place? The only transaction that happens is that the investors give us their preference shares, against which we give them equity shares. So that is the transaction that is taking place. There is no movement of money whatsoever. In that case, should we record it in our cash flow statement? Obviously not. A company should not record any non-cash transaction which is relating to investing or financing activities in its cash flow statement. So let's read it. A company does not generate any cash inflows or outflows from non-cash investing and financing activities. However, these activities can still have a material effect on the company's financial position. So conversion of preference shares into equity might not have that big of an impact. However, conversion of debentures into equity, it has a major impact. So what does conversion of debentures into equity does? Debentures into equity. So what is the biggest impact? Our liabilities as a whole would go down. There will be a reduction in liability and increase in owner's capital. I hope everybody understands what I mean when I say that. So when we convert debentures into equity shares of the company, when we convert the debentures of a company into its equity shares, the liabilities go down while the owner's equity goes up. So what will happen? Every ratio that we have learned about will have a major change. Be it the total debt to equity ratio, every solvency ratios that we read about. Certain liquidity ratios might also be impacted. There are many ratios, and when we learned about ratios, what did we learn? That ratios are one of the most important things that financial statement analysts look for. They read and interpret the ratios to move forward. I hope that that is very clear to everybody. So it might have a major impact. However, these will not be recorded in the cash flow statement. So let's read the examples. Issuance of common shares for dividend purposes or conversion of convertible bonds or convertible preference shares. We already talked about this. However, we did not read about issue of common shares for dividend purposes. What does this mean? The company might give dividends to its shareholders. However, sometimes instead of issuing dividends in the form of cash, the company might issue fresh equity shares in the place of dividends. In those cases, it is called bonus. It is also called bonus shares. So in that case, even though there is no money exchanging hands, yet a major transaction is taking place which will impact the solvency position of the company. It will change the ratios. So that is an example of a non-cash equity, which non-cash activity which will not be recorded in the statement of cash flow. And next, exchange of one non-monetary asset for another non-monetary asset. So the examples that we did till now related to cash flow from financing activities. In the cash flow from investing activity, let us say that purchase of any asset. Instead of buying a car outright, what we might do is that we might exchange our existing car for a new car. And let us assume that we do not have to pay a single penny for the new car. Our old car covers the entire cost of the new car. In that case, what will happen is that we are not recording any value in the statement of cash flows. However, a major transaction which will impact the future earning potential of the company is taking place. So that is also something that we need to make sure that we are keeping in our mind when we read the statement of cash flows. Note, these transactions might be recorded in the footnote or the supplemental schedule to the cash flow statement. That is not compulsory. So I hope everybody knows what's coming next. Before moving forward, I hope that we all know that which company we are going to look at and whose financial statements are we going to open. Just hold on a second. My internet is not working, everybody. I will be opening the financial statements of a listed company in the US stock exchange. So that will help us to better understand how a cash flow statement looks in the actual annual report of a listed company. Okay. So here it is. This is the annual report of Facebook or Meta as we now call it. Okay. So here it is. This is the consolidated statement of cash flows of Meta, right? So let's see whether the three components that we mentioned are here. The first being cash flow from operating activities. Okay, these values are in millions of dollars, right? So the first is cash flow from operating activities, and Meta has presented its cash flows for 3 years. Now this is not something that Meta is doing out of some good faith towards its shareholders. It is compulsorily required for all shareholders in the US, all companies in the US. In India, we are mandatorily required to present the cash flow statements of 1 year and one comparative period. So for 2021 and 2020. So 2 years financial cash flows are compulsorily required in India. Okay. So the first being cash flow from operating activities. Next, cash flow from investing activities. And finally, cash flow from financing activities. I hope everybody is crystal clear with the three components of cash flow statement and what do they mean. Now, once you are clear with that, we'll move forward. Now, I think we should do this at the last. Once we understand what value should be presented where, we'll learn about the differences between IFRS and US GAAP after we have learned about a lot of different things like where every item of balance sheet and profit and loss account should be presented in the cash flow statement. After we have learned about that, then we will come to understand what are the differences between IFRS and the US GAAP. I hope everybody is very familiar with these terms by now and you do not have any problems. If you do, then please go to our first and second classes and go through them. There we have talked a lot in detail about what are standard setting bodies, what are accounting standards, the meaning of accounting principles and everything in detail. Okay. So let us understand what is the link between the cash flow statement and the balance sheet first. So as we have already read when we were learning about the components of balance sheet, that cash and cash equivalents is an asset to the company. Being an asset, cash is a balance sheet item, or it is a component of the balance sheet. So cash is an asset and is reported on the balance sheet, which I hope everybody knows, but let us just show you so that there are no doubts. So this is cash and cash equivalents. The closing cash and cash equivalent here is 16,601. So let us just confirm whether the cash flow statement of Meta is matching with its balance sheet. So cash and cash equivalents closing here is 16,601. So here we saw that cash and cash equivalent is a balance sheet item. So what the cash flow statement does, it presents what did the changes that occurred in the value of cash from the previous year till current year. So let us say that the last year beginning cash is $1,000. So we learned that whenever we are presenting our financial statement, we are presenting a comparative value along with the current year's value, right? So cash equivalent. Let us say this is $1,000 and in 2021 it is $500. When we read about this in the balance sheet, we learn that the cash flows reduced. Is this a good thing? Is this a bad thing? We don't know. We need to understand and interpret the change that has occurred in the cash value from the previous year to the current year. So that is something that we need to understand, and for that we refer to the cash flow statement. When we read the cash flow statement, we will be getting details of what specifically caused the changes in the value of the cash. So let us say we learned that during the year the cash flow from operating activities was $15,000 and cash flow from investing was $15,500, whereas cash flow from financing activities, let us assume, was zero. So when we get such a cash flow statement, what do we understand? That the operations of the company are generating a lot of revenue, a lot of cash flows, but the company is smart and they're investing their excess cash into new machinery, or they're trying to expand. When we see a lot of negative cash flow from investing activities, that is a positive sign in general. Generally, that will be a positive sign for the company because that will present that the company is investing for the future. So what should we look at in a company when we are looking at the cash flow statement? Generally, for a mature company, we would want the cash flow from operations to be highly positive. We would want the cash flow from investing to be mediocre negative, because we want the cash that is generated from in operating activities to be invested into the future of the company. So that is why we would prefer the company to invest more money into its future planning, into its future machinery. And as for financing, we would want to repay all our debts. We would want to repay the investors. We would want to give dividends. So everything that is coming under financing, that is also an outflow. So we would prefer for a mature company to have, I'm reusing short forms. So cash flow from operating, CFO, should be positive. Cash flow from investing should be negative, and cash flow from financing should also be negative. If this is the situation, then we will get a positive outlook. However, we still need to get into the details, but when we see an overview like this on a cash flow statements, we get a positive impact, we get a positive vibe from our company. So we learned about the link between the balance sheet and the cash flow statement. So cash is a balance sheet item. So the beginning cash balance plus cash receipts from operating, investing and financing activities minus cash payments for operating, investing and financing activities gives us the ending cash balance. This is pretty self-explanatory, but we have understood the meaning of linkage between the cash flow statement and the balance sheet of the company. Now, there are two methods of preparing the cash flow statement. Hello. Okay. So there are two methods to preparing the cash flow statement. The first is the direct method. And the second being the indirect method and the direct method. Okay. So first and foremost, what we need to know is that both the US GAAP and IFRS recommend the direct method. However, again, both the standards allow both the direct and indirect method. So there are no restrictions, but it is recommended by both the standards to follow the direct method. However, later you will learn that most companies do not follow the recommendation and they go with the indirect method. And we will also learn why. Why do most companies follow the indirect method? We learn both. So for another thing, cash flow from investing activities and cash flow from financing activities are same in both the methods. There is no difference between the cash flow from investing activities and cash flow from financing activities. The only difference between the direct method and the indirect method comes under cash flow from operating activities. I hope that is clear. So in the direct and indirect method, both are allowed, and cash flow from investing and cash flow from financing are allowed are the same under both the methods, direct or indirect. However, cash flow from operating is different. I have an example prepared in our PPT, and we'll be looking at that just to get a gist of what are the differences. Then we'll be learning the components of the differences as we go on. So here we will only be learning about the cash flow from operating activities first, because we already learned that that is the only differential portion between the direct and indirect method. Again, it's written that both IFRS and US GAAP encourage the use of direct methods but allow either method to be used. Under the US GAAP, however, company must present a reconciliation statement between the net income and cash flows when they use the direct method. Ironically, this is equivalent to the indirect method. We will learn about this also. Do not get confused. We will learn in detail what does this mean of this being equivalent to the indirect method. Okay. So what is the direct method? In the direct method, each cash inflow and cash outflow related to cash receipts and payments are shown, while the impact of all accruals are eliminated. So what did we learn? Under the direct method, each item of cash inflow and cash outflow are written separately. That means, let us say, first one foremost, receipt from customers. So it's written as receipt from customers. Payment to suppliers. Payment to employees. So whenever we are presenting the cash flow under direct method, what we do is that we simply write every reason for our cash flow from direct operating activities, and what we have done here is we have eliminated the effect of accruals. So that means, if for example we sold $1 million worth of goods during the financial year, $1 million worth of sales happened during the financial year. However, the entire sale took place on credit. Now, during the year, we collected, let us say, 800,000 from debtors. So, under the direct method, which figure are we going to use? The $1 million figure or the $800,000 figure? Obviously, we are going to use the $800,000 figure. So, here we will write $800,000. I hope you understand what I mean. So what we are going to do is that we are going to write the reasons for every cash flow that happened in our operating activities, and we are going to separately list each one. What we will not do, we will not write the impact of accruals. So if any sale occurred on accrual whose cash has not yet been received, we will simply ignore that. So what kind of sum can come in the exam? What can happen is that you can be given opening debtors is $200,000. Sales on credit during the year is $1 million. And closing debtors is, let us say, $350,000. So how much cash was collected from the debtors during the financial year? This is a kind of sum which we can give, which can be given to us. So how will we find that out? So cash realized from debtors. It is a very simple mathematics, but we all should know it. So since opening we know is 200,000 and during the year we sold $1 million. So the closing should be $1.2 million in case no cash is received. But since some cash was received, that is why the closing is not equal to $1.2 million. The closing figure is $350,000. So 1.2 million minus $350,000, that is $850,000 is the actual cash that was realized from our debtors. So when we write it as a formula, how will we write it as a formula? Opening debtors plus sales minus closing debtors equals to cash collected from debtors. I hope this is clear to everybody. For people from an accounting background, what we can also do is we can prepare a ledger. So we need to balance 200,000 to sales 1 million by cash received. This is the balancing figure, and by closing balance is $350,000. So 1.2 minus 350 is $850,000. This will be the balancing figure. So I hope both the methods are clear. You can use either one. Also, please understand everything we are doing. The exam can get more complicated. To get more complicated, what they can do is they can add additional figures. They can mention that discounts were issued to the debtors, certain debtors got bad debt. So in those cases also we should understand how to calculate the cash actually received. In this, for example, if I say that $100,000 became bad debt. So if $100,000 became bad debt, what is the actual amount that was received? The opening debtors are $200,000. The sales that we made is $1 million. So the total debtor should be $1.2 million, right? Now from the $1.2 million, $100,000 became bad debt. That is, they are no longer receivable, but money was not received also. So they are simply written off in the profit and loss account. So now the new balance, new closing balance for debtors became $1.1 million. And from this, the closing balance actually is $350,000. So $1.1 million minus $350,000 gives us the amount that was actually received from our debtors. You can expect these kind of sums in our examination. So if you have not understood, you can call me and I will be there to guide you at all times. Okay. So in the direct method, each cash inflow and cash outflow related to cash receipts and payments are shown while the impact of accruals is eliminated. I hope everybody understands this line now. The primary argument favoring the direct method is that it provides information on the specific sources of cash receipts and payments. So like I said, every item of cash flow, if there's a cash transaction happening, we will simply write it as a line item. So let's see, cash collection from customers, cash paid to suppliers, cash flow for other operating expenses. Other operating expenses can be electricity, payment for our rent. All these activities are other operating activities. So cash flow from other operating expenses, cash flow from interest, cash flow for taxes. I hope this is clear to everybody. So this is because when we read this, it is much more clearer. That is why cash flow from the direct method is much more favorable. However, why do companies not follow the direct method? We'll soon learn about that also. Okay. In the direct method, this is just an explanation of we have already learned of how the direct method is used to prepare the cash flow from operations. So in the direct method, we take each item from the income statement, each item. So what were the items of income statement? Revenue, ex revenue, expenses. Under expenses, there were cost of goods sold. There was employee benefit expenses. There was financing cost. So there were several different items, line items under the statement of financial performance or the income statement. And we need to convert it to cash equivalent by removing the impact of accrual accounting. How do we remove the impact of accrual accounting? We already learned that with the example of debtors. So instead of debtors, it can be something else also. Let me give you a sum to solve before we move forward so that we just understand that everybody is understanding what they are doing. Let's say opening trade payables or accounts payables, $100,000. Purchases during the year, on credit is, even if I do not mention credit, then also the formula will remain the same. Okay, $1.5 million. And closing trade payables is $250,000. This is a very simple sum and I hope everybody can do this. I'm giving you 1 minute to solve this. Okay, you can look up at the board and the answer is there. So the actual cash payment that was made for the purchases of goods equals to opening trade payable plus all purchases minus the closing trade payables. That gives us $1.35 million. I hope everybody can understand how we remove the impact of accruals from every line item of the income statement. So this is how we are removing the impact of accruals, right? The rules to adjust are, so if you want to mug it up, which I highly do not recommend, please do not mug up. It is very simple. I want everybody to understand each and every transaction, each and every adjustment entry that we are doing. If you have any queries, you can call me. But the rules that are given here. Increase in asset is use of cash. So that means if assets are increasing, I'm to buy any asset, to increase any asset, that means cash is being utilized. So increase of asset means a negative adjustment. Similarly, decrease in cash is an increment of cash. So if my asset is reducing, for example, inventory, if inventory is going down, that means I've sold my inventory. So reduction in any other asset is a positive adjustment for cash, while addition of any other asset is a negative adjustment for cash. It is the absolutely mirror effect for liabilities. So if liability is increasing means cash is coming in. That means I have taken something on credit. That means I have not paid, but I have received the benefits. For example, I have borrowed money from someone. So borrowing money means increase in liability. Borrowing money will increase my borrowings. That is a part of liability. And when I borrow money, what do I get? Cash. So an increase in liability would mean a positive adjustment for cash and cash equivalent. Similarly, the complete opposite, a decrease in liability is the use of cash or a negative adjustment for cash and cash equivalent. I hope this is very clear to everybody. It is very simple to understand. So, cash collected from customers adjust sales for changes in accounts receivable and unearned revenue. For unearned revenue, what do they mean? They mean that money has already been received, but we have not yet provided the services to them. So that amount of money will be presented in our balance sheet instead of statement of financial performance. Unearned revenue. Where does unearned revenue where is unearned revenue presented in our balance sheet? It is recorded as a liability. So the transaction is money is coming in and we are recording a liability because we have to give them some goods or services in the future. We have a liability to provide them with goods or services in the future. So that should also be taken into account while preparing our cash flow statement. Adjust for accounts receivable, we already learned that adjustment for accounts receivable and unearned revenue. Similarly, for inputs, adjust cost of goods sold for changes in inventory and accounts payable. That is also what we just learned. Cash operating expenses, adjust selling and administrative expenses for changes in relation to accrued liabilities or prepaid expenses. This is the same thing. That just means if it might be written opening accrued other expenses incurred during the year on accrual basis, and closing accrued expenses. So we need to make the similar calculation to remove the impact of accruals. Cash interest paid, adjust interest expense for changes in interest payable. This is again the same. So every line item requires a similar adjustment. But what we need to understand that there might be certain items which we have not discussed, but they might come in the exam. We'll be doing one more sum at a later point when we'll do the entire cash flow statement. That is when we'll do it one more sum just to get a gist of to see whether we have understood everything. Next. So instead of starting with revenue, when we are using direct method, where are we starting from? What is the starting point? Cash collected from customers or the revenue, that is the starting point. So this is the first line item in the income statement, which is the starting point for the direct method of cash flows. But when we go to the indirect method of cash flow statement, where do we start from? In the indirect method of cash flow statement, for preparing cash flow from operations, we start from the final line or the last line, that is net income of the company. So we are the starting point in case of an indirect financial state in indirect cash flow from operations is the final line item of the profit and loss account, that is the net income. This is the starting point, right? Let us say that is $1,000. After we put down the net income, what do we know? That in the net income there is everything. So net income is calculated on an accrual basis. So the effect of accruals needs to be removed from the net income to get the actual cash flows. But apart from net accrual, there are also items of a non-cash nature. For example, depreciation. Depreciation is a non-cash item which is present in the net income. So there might be other non-cash items which might be present in the statement of financial performance or the and its impact might be taken in the net income. So we need to make adjustments for non-cash items. Again, there might be certain items which are of a non-operating activity, even though those activities relate to the financing. Those activities might relate to cash flow, so actual cash flows are taking place, but they are not for operations of the company and are present in the statement of financial performance. I want you all to think of an example before you hear my example. Excuse me. Okay, so one very good example can be gains or losses on sale of fixed assets. So the gains, and when we are selling our fixed asset, that is an investing activity. We already learned anything related to fixed assets is our investing activity. So when we sell our fixed asset, if the cost of the fixed assets in our books of accounts is $100, but we sell it for $120, so the additional $20 that is a gain to the company is present as an other income component of the statement of financial performance, and it is reflected in the net income of the company. However, that is not an operating item, right? So we will remove the impact from here. For example, depreciation. Since depreciation has already been reduced while calculating the net income, that is why we'll add it back. And let us consider what are gains. Gains are income, so it is added while we are calculating the net income. So we will reduce the gains on sale of fixed asset. When I'm writing any value in brackets, that means a negative figure. I hope everybody knows this. So this is the first adjustment that we will do while calculating the cash flow from operations under the indirect method. Adjustments to reconcile net income to cash flow provided by operating activities. So first will be non-cash and non-operating activities. Deferred income taxes. We learned the meaning of deferred income taxes in the previous class. Now deferred taxes, the impact can be positive or negative. If deferred taxes had a positive impact, that is it increased the net income, then we will reduce it. And conversely, if the deferred taxes led to a reduce in net income, then we will add it back. It's very simple. We will just remove the impact of the deferred income taxes from the net income component. I hope that is clear. Then after all these adjustments, what we will need to do next is we will need to remove the impact of all accruals. Now, when we were doing the cash flow from operating activities under the direct method, we were calculating those first and then we were putting in the value of the actual cash item. But since in indirect method, we have already started with the net income, we will now need to remove the impact of accruals. To remove the impact of accruals, what we will need to do? We will add all reductions in current asset or increase in current liabilities, and we will reduce all increase in current assets or reductions in current liabilities. What does this mean? So we already learned that when the current assets are increasing, when there's an increase in current assets, then what will happen? There will be a negative adjustment to the net income. Sorry, there will be a negative adjustment to the cash flow statement, right? So for example, if the debtors are increasing, during the year, that means that the cash flows received is less than the sales that took place. So that means a negative adjustment needs to be done for the changes in debtors, right? Similarly, for all items of current assets and all items of current liabilities, we need to do these adjustments. So for every increase in any current asset, there will be a negative impact on the cash flow statement, and for every reduction in the current assets, there will be a positive impact in the cash flow statement. Okay, now we need to know, why did I mention current assets and current liabilities and not non-current assets and non-current liabilities? This is because generally there is no impact of non-current assets and non-current liabilities in the net income. What constitutes non-current liabilities and non-current assets? Generally, what comes under non-current assets is fixed assets. The purchase or sale of fixed assets do not come under the statement of net income, the statement of financial performance, that is not presented. Or let's say long-term loans and advances, there is no impact of long-term loans and advances into net income, right? So, and for non-current liabilities, what are the non-current liabilities? Long-term borrowings, other non-current liabilities, deferred tax liabilities, and long-term provisions. These are the non-current liabilities. So there is no impact of any of the non-current liabilities or non-current assets into the statement of financial performance or the net income. That's why any increment or decrease in non-current assets or liabilities need not be adjusted. However, if we know that there is an impact of such non-current assets or liabilities in the profit and loss accounts, then we need to adjust that also. However, in case nothing is mentioned, we do not need to do that. We just need to make sure that we are adding all reductions in current assets, adding all increments in current liabilities, reducing all increments in current assets, and reducing all reductions in current liabilities. I hope everybody is clear till now. So this is just an example of an indirect format, just like this one was an example of a direct method. So what do? We started with the net income. We added non-cash. These were two non-cash items that we added back. Then what did we do? We reduced increment in current asset. We reduced increment in current asset. We reduced decrease in current liability. Prepaid expenses. Oh, sorry. Prepaid expenses again is an asset. I'm sorry. So a reduction in asset is added. So we added a decrease in current asset. Account payable is a liability. So we added back increments in current liability. we added increment in current liability. So this is consistent with the formula that we talked about just now. So this is the formula that you need to keep in mind while calculating the cash flow from operations using the indirect method. So these kind of sums can come in your exam. You will be mentioned the net income, then you will be mentioned several non-cash, non-operating items. You can be mentioned the changes in the various assets and liabilities, and you need to calculate the cash flow from operations. Again, this slide mentions the steps that are taken into calculating the cash flow from operations using the indirect method. The indirect method shows how cash flows from operations can be obtained from reported net income. So we start at net income. Starting point is the net income of the company. We begin with net income. We add back all non-cash charges and subtract all non-cash components of revenue. So there might be certain non-cash components of revenue also, right? So depreciation is a non-cash item of expense. Similarly, if there is some non-cash item of a revenue, what might be a non-cash item of revenue? Let us say revaluation of asset. A fixed asset has been revaluated and the value is increased, and it has been presented in the statement of financial performance. That will increase the revenue, but this is a non-cash item. That is, there is no impact in the cash flows of the company. So what will we do? We will reduce this increment in revenue because of a non-cash item, right? Then we subtract any gains that resulted from financing or investing activities. So what did we write for that? We have written adjustment for non-cash and non-operating activities. So any cash flow from investing or financing activity that has been considered while calculating the net income needs to be adjusted. Then add or subtract changes to related balance sheet operating accounts. This means the adjustment for current assets and current liabilities, right? We learned that we need to make the adjustment for accruals since the net income is calculated on accrual basis. Decrease in operating assets should be added, increase in operating assets should be subtracted, and this we have already talked about. After that, what we will get is the cash flow from operations. Okay, I guess we should take a 5-minute break now. It is 6:33. We will start at 6:40. Let us take the 5-minute break and we'll be back. Okay, welcome back everybody. I hope everybody has taken their break. Now before moving forward, let us go back to the differences between IFRS and US GAAP. Alright. So there are many items that we discussed which need to be presented differently under US GAAP and under IFRS. So we need to understand what are the presentations that are allowed under US GAAP and under IFRS. It's very simple. It's not complicated at all, because we just need to know that IFRS is always giving us more options. As long as you remember that, you'll be fine. So let's see. So interest received. When you listen about interest received, where do we receive the interest from? The interest might be received from bank FD. It might be received from any loans that the company might have given to any subsidiary or any other companies. Those are the sources from which the company might receive interest. Now this interest income should generally be present under financing. However, some people might contend that since it is a part of operations of the company to invest the money, that is why it should come under operating activities. Even though the investment itself is a part of investing activities, but the income that is the company is earning from the investments is a part of the operations of the company. So now under IFRS, you are allowed to present this interest income under both operating or investing activity, but US GAAP mandatorily requires you to present it as an operating activity. The US GAAP is not giving you any options. If there's an interest income under US GAAP, you should present it as interest income, or it is an operating activity. Now interest paid. Why do we pay interest? We pay interest for financing. That means when we have borrowed any loans, now we learned that the loans borrowed in itself are a financing activity. That is, when we are raising any sort of money for the company, that is a part of the financing activity. So now any payments that is made to the financiers of the company, to the borrowers, to the lenders of the company, should be a part of financing activity. However, again, we can contend that since that money was raised for the running of the operations of the company, and the money is being utilized for running the operations of the company, so the expenses incurred for raising the finance should be a operating activity. Even though the raising of finance, that is the borrowing itself, should come as a financing activity, but the interest component should be a part of the operating activity. Accordingly, IFRS again gives you an option to present it either operating or financing activity, but again US GAAP mandatorily requires you to present it as an operating activity. So under US GAAP, you see all first three are presented compulsorily as operating. Right? What is the third item? Dividend received. This is absolutely similar to what? Interest received. Dividends are received against what? When we invest the additional money of the company into shares of different companies. It might be preference shares of a different company or equity shares of a different company. And when those shares give out dividends, then that is known as dividend received. Again, the investment itself might be an investment activity, but the money that is received from that investment, that is the dividend, might be investment or operating. So under US GAAP, that is mandatorily operating, whereas IFRS makes it mandatory. IFRS gives an option under operating and investing activity. Now finally, dividend paid. Who do we pay the dividend to? We pay the dividend to shareholders of the company, and shareholders are the primary financiers of the company. Again, when we are making any payment to the financiers of the company, it should be under what? It should be under financing activity, right? But the same logic can again be applied, that any income that is being paid to the financiers can be a part of operating activities, right? So any payment that is being made to the financiers of the company can be made for operations. So IFRS again gives the option of operating or financing activity. But under US GAAP, this time it is compulsorily financing. So dividend paid is financing activity under US GAAP. You need to make sure this time no operations. This time it is a financing activity. So what did we learn? Interest income, IFRS, either operating or investing. Interest income for US GAAP, it was mandatory operating. Interest payment for IFRS allowed us either operating or financing activity. But under US GAAP, mandatory operating activity. Then we went to dividend received. Dividend received under IFRS is either operating or investing activity. But dividend received for US GAAP is compulsorily operating activity. And finally, dividend paid. Dividend paid is special because in this case US GAAP is different. So dividend paid under IFRS again operating or financing activity, but under US GAAP only financing activity. Only financing activity. Now income tax. So income tax is paid against the income that the company is generating. 1 second. Okay, I'm sorry for the delay. So let us continue. So now income taxes. Income tax expense that is paid against the income of the company. Now that income might be in relation to investments of the company. That income might be in relation to financing activity. There might be different reasons for payment of the tax. For example, let us say we received dividend. So now dividend, if we are presenting the receipt of dividend, we are presenting as an investment activity. Now the income tax that we are paying on that dividend, that should be also investment, because that tax is relating to an investment activity. I hope you all understand that. So what should we do? US GAAP says use the easy way. Classify every tax as an operating tax or operating activity. However, IFRS again gives an option. Income tax is generally classified as an operating activity. In spite of this, a portion of it might be allocated for investing or financing activity relating to specifically those activities for which it is taking place. So for example, if there is any income directly related to investing activities and the company is paying any taxes directly in relating to investing activities, then we can classify those income taxes as cash flow from investing activity. But again, that is an option. You can directly put taxes under operating activities. I hope everything is clear till now. So IFRS is always giving more options, whereas US GAAP is more rigid and you need to follow only one way. Under US GAAP, it's my way or the highway. So how you can remember this? US is very strict and they say you have to follow my method, whereas IFRS or the International Financial Reporting Standards, they're more liberal and they will allow you to use many different methods. Again, now let's move forward to bank overdraft. What is bank overdraft? And when we open a current account in the bank, when companies and businesses open their current accounts, banks allow certain overdraw limits to companies. So for example, if I have let's say $100,000 in my bank account as a current account, I can withdraw more than 100,000 and the bank will charge certain interest for that. So instead of $100,000, I might be allowed to withdraw up to $120,000. So if I, let's say, withdraw the entire $120,000 that the bank is allowing me, so this $20,000 will be presented in a balance sheet as a negative cash balance or a bank overdraft account. I hope you can understand this, that this will be presented in our financial statements in the balance sheet as a bank overdraft or a negative balance on cash and cash equivalent, or it can be presented under short-term borrowings. So such bank overdraft can be added to cash and cash equivalents, can be included in cash and cash equivalents. in IFRS. However, US GAAP says no, you cannot say that bank overdraft is a part of cash and cash equivalent, and US GAAP says that it is a kind of loan to the company, and so it needs to be presented under cash flow from financing activities. This is cash flow from financing activities. I hope this line is also clear to everybody. And finally, the statement of reconciliation. IFRS has no need for any statement of reconciliation. However, under US GAAP, if we are following the direct method, then we need to prepare a statement of reconciliation. What is the statement of reconciliation? We need to prepare the statement of reconciliation from the net income to the operating cash flow. Read what's written. The statement of the US GAAP requires reconciliation of net income to cash flow from operating activities must be provided. So under US GAAP, even if you are presenting the cash flow from operations under the direct method, you need to present the reconciliation statement, which will indirectly be the indirect method. So does this make sense for a US company to prepare the cash flows from direct method? Because you will anyways have to present the cash flow from indirect method, cash flow from operations. So what do US companies do always? They always go for the indirect method. So let us look at Facebook, which is again a US company. I hope that they will have prepared under indirect method. So where do they start their cash flow from operations? Net income. So which method is US following? Is Meta following? They're following the indirect method of preparing cash flow from operations. See, so it does not make sense for any US company to follow the direct method. And even though it makes sense for other companies, yet we will learn that most companies do not, and they always follow the indirect method. Why? We will learn later. Okay, so now let's move forward. Please ignore this strike through. This was done by mistake. Okay. So now let us get to, we have learned all about cash flow from operations and how do we calculate the cash flow from operations. And even though I have given you a brief gist of what are the components of cash flow from investing activities and cash flow from financing activities, but let us learn in detail. Okay, so cash flow from investing activities include any investments that the company are making. So any purchase of fixed assets or sale of fixed assets, any purchase of investments, sale of investments, everything becomes a part of the cash flow from investing activities. So cash flow from investments is calculated by examining one second. My pen is not working. Just 1 second, everybody. Okay, so cash flow from investing is calculated by examining the change in gross asset account that results from investing activities. Typically, the change results from purchases or sale of equipment or long-term assets to determine the cash inflows. So now let us take an example. We are given that the opening gross fixed assets is, let's say, $100,000. Closing first, let's just get done with opening. So opening accumulated depreciation on those fixed assets is, let's say, $15,000. So we all know the meaning of depreciation. Now the value of depreciation keeps getting accumulated, and in the balance sheet we present the net figure, that is gross fixed assets minus the accumulated depreciation. So this is the opening value of fixed assets and the opening value of depreciation. Let us take a simple example first, and there are no sales that are happening. So we are given again the closing accumulated depreciation is, let's say, $25,000, and closing gross fixed assets is, let's say, $150,000. So if this is given, this is a very simple sum, and there are two impacts from this information that can be given to in the cash flow statement. When we subtract closing gross fixed assets minus opening gross fixed assets equals to, what will it give us? Purchase or sale of fixed assets. So in this case it's $150,000 minus $100,000. So we know that $50,000 worth of sale purchase took place during the year. The company purchased $50,000 worth of fixed assets. So that is the impact. So negative $50,000, that is a cash went out and machinery came in. So we paid $50,000 during the year for purchase of machinery. I hope this part is clear. So this will be presented in our cash flow from investing activity, and the other impact will be depreciation. So closing depreciation minus opening depreciation is $10,000. So where will this come? Will this come under investing activities? Depreciation is a non-cash item, so it will not form part of cash flow statement. But if we are presenting the cash flow statement from indirect method, then depreciation will be added back to net income, which is calculated after taking into account depreciation. So let us see what's written here. Cash flow from sale of equipment equals to gross value of fixed assets sold minus accumulated depreciation on equipment sold plus gain on fixed asset minus loss on sale of fixed asset. So let us understand this. So what they're saying is that what we are saying is that basically we need to calculate how much money was received from the sale of fixed assets. And the information given to us is this. Fixed assets sold, gross value of fixed assets sold is, say, $100,000. The accumulated depreciation on such fixed assets which have been sold, let's say $70,000. So what is the book value from this information? we know that the gross value is 100,000 and the depreciation on which is already been charged on this asset is $70,000. So the book value of such assets is $30,000. Gross minus depreciation is $30,000. So we know the book value. And now let's say we sold this for X amount of money. We will make either a profit or loss unless we sell for exactly $30,000. If we sell for $20,000, then there is a loss on sale. And if we sell for $40,000, then there is a gain on sale. If this value of sale is not equal to the book value, then there will be a profit or loss on the sale. So let's say we need to find out cash flow from sale. From sale of such fixed assets. Case 1. Profit $15,000. And case 2. Loss of $5,000. So in case 1, we know there's a profit of $15,000. So what is the cash that was sold for? Equal to book value plus gain on sale equals to $30,000 plus $15,000. So the actual cash flow that was received from the sale was $45,000. And case 2 you can easily do equals to book value of FA minus loss on sale. That is given to us. So $30,000 minus $5,000. That gives us $25,000. So $25,000 was the actual cash that was received on the sale of such fixed assets. So from this formula what we get? Gross value of fixed assets minus accumulated depreciation. This is nothing but the book value or net value of fixed assets sold. This is nothing but the book value or net value of fixed assets sold plus gain minus loss gives us the cash which was received from the sale. Again, this is something we have already done. How do we find the book value, the gross value of fixed assets sold? If we have been given the gross value of all assets, opening and closing, and we have been given the gross value of fixed assets purchased during the year. So opening plus purchases minus closing gives us the value that was sold during the year. This is very simple. And similarly for depreciation, so this formula is kind of confusing, but I'll just simplify. So while calculating accumulated depreciation, we need to make sure whether the accumulated depreciation relates to all the fixed assets in the books or only the fixed asset that was sold. So for this formula, it means accumulated depreciation for assets sold equals to beginning accumulated depreciation for assets sold and plus depreciation for assets sold. I hope everybody is clear with this. So this is how we will calculate the cash flow from sale of equipment. What are the other items that can come under cash flow from investing activities? The purchase of fixed assets. Similarly, it will be the complete opposite of the formulas that we have done here. We can use the same formula, and if there's a negative figure, that will come under purchase. So purchase is a negative cash outflow, whereas sale is a cash inflow. So these all items will come under the cash flow from investing activities. Next, we come to cash flow from financing activities. Relates to cash flow between the firm and suppliers of capital. Who supplies the capital or financing to the company? Who are the financiers of the company? The lenders, the banks, financial institution from which they have taken loans. We have taken money from preference shareholders, debenture holders, preference shareholders. All these people provide capital to the company. So they are the financiers of the company. So any payment that we have received from them or repaid to them will come under cash flow from financing activity. Creditors here does not mean trade payables. This means creditors means lenders or the banks, bondholders, shareholders. These are the people who are providing financing to the company. So again, cash flow from financing, CFF means cash flow from financing, which is equal to net cash flow from lenders plus net cash flow from shareholders. Any money that we have received from lenders will be positive or cash inflow, and any money that we have repaid is cash outflow to the company. From lenders equals to new borrowings minus principal repaid, and from shareholders equals to new equity minus shares repurchased minus cash dividends. Now we will come to think like a financial statement analyst. We have already learned what are the components of the cash flow statement and what are the parts and what is included in every component of the cash flow statement. So now that we know everything, we need to understand how will we interpret it and how will a financial statement analyst use it in his analysis. So like we already discussed when we were starting this chapter, that for mature companies, what will we want? We will want the cash flow from operations to be positive, and cash flow from investments and cash flow from financing might be negative as well. So that is what is written in the first point. As an analyst, we will not look into, we will just not see what are the cash flows happening in without any interpretations. That is just the raw data. When we are given the raw data, we need to convert it into information by interpreting the data. So when we see positive cash flow from operations, we know that the company is earning profit from running its business. A negative cash flow from investment will tell us that the company is investing into its future. The company is using the money that it is generating from operations to invest into new machinery, new plant, so that they can increase their revenue and increase their future economic viability. That is how an analyst should look at it. When we are looking into every aspect, then when we go into cash flow from operations, we are looking into positive cash flow. Then we need to see whether the positive cash outflow from operations is due to increasing sales, or is it simply because we are receiving money from the old debtors and there's no new sales. What can happen is that there might be net income of only $1,000. In previous years, the net income might have been millions of dollars. In this year, it might be only $100,000. However, in previous years, the cash might not have been received, and even though the net income was very high during the previous years, but the money was not received from the debtors, and that was presented, the net income was high only due to the accrual principle. And in the current year, there is no income, that is the net income is very low in compared to previous years. But what has happened is that the old debtors which were in the books of accounts have repaid their debts. So we have actually received money for the old sales that happened. Does this mean that the company is profitable and is heading towards a good future? No. So what we need to do, we need to inspect why is the cash flow from operations positive, and what is the best sign that the company is earning high net income. The company is getting more receipts from new sales, not old sales. See, this is written. We need to evaluate the primary dependence of the operating cash flows. Analysts should compare operating cash flows with net income. So one ratio that the company can use is net income to cash flow from operations. And what does the analyst want? It should be as close to 1 as possible. If the net income and cash flow from operations are very close to each other, that means that the company is stable. And if there are many major discrepancies, that automatically does not mean that the company is bad, but we need to inspect the reason for differences. We need to understand why the company is earning more cash flow from operations or less cash flow from operations in relation to the net income. So if the company has, let's say, very high net income, but the cash flow from operations is very low, what will that mean? That means that the company is earning bad income, the poor earnings quality. The earnings quality of the company is poor. That means the company is making sales, but they are not realizing the cash, and the debtors might become bad in future. It might be recorded as expense in the future as bad debt. So there's no point of earning such income, right? So we need to evaluate the primary determinants of operating cash flows. Next, what we need to do is evaluate the primary determinants of investing cash flows. For example, like I said, if the company has large negative cash flow from investments, that is generally a good sign, because that means the company is investing in the future. However, if we see that instead of investing in plant and machinery, the company is investing into shares and securities of different companies. If a manufacturing company is investing into shares and securities of different companies, what indication that it gives us? That the management does not believe that they will be able to make more sales. If they expect that the sales is going to increase, they should increase the capacity of the company. They should increase the manufacturing capacity. But if they are not buying new assets, that means that they are not planning to invest more money, that they are not expecting new sales. So that is a major negative sign. So let us see Facebook. See, Facebook has negative purchases of property, plant, equipment, negative purchase of marketable securities. That means that Facebook is investing into its future. They are buying new machinery because they are expecting increased volumes in the future. So this is a positive sign. And the net purchase of purchase or sale of marketable securities is positive. That means that the company is unloading its investments, and they are using it to invest into plant and equipment. That is also a positive sign. That means we can see that the company is expecting its volumes to grow. They're expecting more cash, more operations next year. So they cannot invest their idle cash into simple investments, but they need to invest into their property, plant and equipment. The rest of the amounts are very small and not really relevant. Okay. So these are basically the points that we have already discussed, but they are detailed mentions about the cash flow from operations, cash flow from investment and cash flow from financing that we need to understand and to interpret. We'll just read through these and we will understand if we have already not discussed some points. So increments and decrements in receivables, inventory and payables can be examined closely to determine whether the company is using or generating cash in operations and the possible reasons for this. So like we said, like we need to check whether the net income is positive and high, and whether or not the company is earning cash flow from operations because of past activities or due to present activities. So if there's a major positive value in cash in the changes in accounts receivable, let's say net income is $10,000, but reduction in accounts receivables is $1 million. So that means that the company is earning $1 million of operating revenue, operating cash flows, but that $1 million is not because of the net income of the company during this year. These are sales that the company made in the previous year, but they're realizing the revenue now. So it is not a positive sign. That is what we learn, that we need to analyze the increments and decrements in receivable, inventory and payable to understand whether or not these profits relate to the previous year and they are just being received in cash this year, or whether or not these are good profit, good sales and good cash flow that a company is receiving. It is useful to compare a company's operating cash flow with its net income. Like we said, we can use the ratio of net income to cash flow from operations. This will give a, this is a good indication, and as close to 1 it is, the better it is generally. For mature companies, it would be desirable to have the operating cash flow exceed their net income by a small amount, not by a very large amount. If the company has a large net income despite a poor operating cash flow, then it could be a sign of poor earnings quality. However, a very large operating cash flow and a lower net income is also not a good sign. The variability in earnings and cash flow should be examined. Further, the impact of the variability of a company's risk profile as well as ability to predict future cash flows for valuation purposes should be interrogated. So what does this mean? We should check the cash flow statements of all years. So we are presenting the cash flow statement of current year and we are presenting a comparable cash flow of the previous year. So we need to check the changes also. We need to check the variability, that variations that are happening in the both the net income and the cash flow statements, and interpret them accordingly. If there's a large variability, for example, the company earned $10,000 in the previous year and there's a negative $1 million cash flow in the current year, then again in the next year, following year, the company is earning $2 million in positive cash flows. There's a large variability, so there's a large risk component. We need to understand why this is happening and whether or not this is going to continue. Again, we learned about how, while we are doing evaluating cash flow from investments, we need to understand whether they are investing into shares and securities of other companies or whether they are investing into their own business. Investment into own business is more positive than investment into shares and securities of other companies. This is what is written here. It is useful to consider the sources of cash and cash for major capital investments. So what does this mean? That when the company is making major investment into new machinery, we need to see where the new machine is coming from. Let us say the company bought a new machinery for $1 million. We need to understand where the $1 million came from, whether it comes from the cash flow from operations or whether the company has taken new loans. So generally what we will find, if the cash flow from investing is negative, there will be a similar positive value in the cash flow from financing. It is not there in Facebook, obviously, because Facebook is a very mature company, but in new companies, where the company is new and they're making new investment into plant and machinery, what we will see generally is that there will be a negative component in the cash flow from financing, which will be roughly equal to the cash flow from investing. So that will mean that the company has raised money and invested the entire money into buying new plant and machinery. So we need to evaluate where the new money is coming from, which the company is using to invest into their property, plant and equipment. Also, when the assets are being sold, it is important to determine why it is happening. If the cash flow from investing is positive, that might be a negative sign, because that might mean that the company is selling off its property, plant and equipment. We need to understand why are they selling their property and what will be the impact. Where are they using the sale of the property, the money? Where are they using this money? Are they keeping it in cash and have they utilized it in the following year, or they have used it to repay their investors? And this might be an indication of the company reducing its operational size. A company, for example, they might see that they are not being able to manage their current levels of operations. So to reduce their operational size, the company might sell off its current property, plant and equipment, and they might use the sale proceeds to repay its investors, so that they have lower financing obligations, financial obligations in the future. I hope this is clear to everybody. So we need to see what the money that is being generated from cash flow from operations, cash flow from investments are being used for. Similarly, in cash flow from financing, we need to see how the company is raising money, and if they have repaid the money, where is the money that they have repaid is coming from. So we see in this, the Facebook has repaid $50,000 million. They have repaid $50,000 million to its shareholders and other lenders, and the money has come from operating activities. So this is a very positive sign. What does this mean? That the company is earning money and they're using its money to repay its lenders, so the future interest obligations will be lower. The company will not have to pay large amount of interest expenses in the future. This is a very positive sign for Facebook. So we have completed the meaning and analysis of various aspects of cash flow from operations, cash flow from investments and cash flow from financing. Next, we obviously come to common size analysis. We have done common size analysis in every previous LOS. We did it in understanding balance sheets, understanding income statements. So what was it? We present the financial statement where every line item is presented as a percentage of something. For income statement, it was that common size common size income statement, every line item was presented as a percentage of the revenue. Under balance sheet, there were two options, but where we cared more about the vertical presentation, and under understanding balance sheets, we learned that the common size balance sheet is presented where every line item is presented as a percentage of the total assets or total liabilities and owner's equity. Under cash flow statement also, there are two options, approach 1 and approach 2. In the first approach, all line items are presented as a percentage of total cash inflows and cash outflows. So what will we do? First, we will calculate the total value of all cash inflows and the value of total of all cash outflows. Then every cash inflow will be presented as a percentage of the total of cash inflow, and every cash outflow will be presented as a total of the total cash outflow. Let me see if they have given a sum. If not, we will create our own sum to understand. Okay, so there's no sum given in the book, but just to understand, we will do our own sum. So we'll do from the direct method, okay? Let's say cash receipts from sale is $20,000. Cash paid to sellers is $15,000. Money received from sale of plant and machinery is, say, $10,000. Money raised from equity issue of equity shares is, let's say, $70,000. Then money paid to employees equals to, let's say, $35,000. Okay, so this is the sum. So step number one, calculate total cash inflow and total cash outflow. In this case, the total cash inflow is 20,000 plus 10,000 plus 70,000, that is $100,000. And the total cash outflow is 15,000 plus 35,000, that is $50,000. I hope this is very clear. This is very simple and clear to everybody. So when we are preparing the cash flow from operations, we will write receipt from customers as a percentage of the total cash inflow. So the total cash inflow is $100,000. So the cash receipt from sale is $20,000. So it will be 20%. Next, cash paid to sellers is $15,000. I will be presented as a percentage of the total cash outflow. So outflows will be presented as a percentage of the total cash outflow, whereas inflows will be presented as a percentage of the total cash inflows. That is 30% of total sales, total cash outflows. Similarly, we can do the rest. I hope everybody understands how we are doing this. However, this can be very misleading, this method of common size statement, because we are using different bases for the inflows and outflows. So what is a better way? Which is the second one. The second approach to common sizing the cash flow statement entails an expression of each line item presented as a percentage of net revenue. So again, this is the same as income statement. So even though revenue is present nowhere on the cash flow statement, yet while we present the cash flow statement, all line items will be presented as a percentage of the net revenue. So this will be a much better presentation for common size cash flow. So this example was given in the book, so let me take that example only. Okay, so they have not given any values, they've just presented. Let us say net revenue is given as let's say $1 million. Net income is $50,000. Depreciation, let's say, is $100,000. Other non-cash adjustments are, let's say, $30,000. Adjustment for current assets and current liabilities, let's say negative $75,000. So how will these be presented? These will be presented as a percentage of the net revenue, which is 1 million in this case. So this will be 5%, this will be 10%, this will be 3%, this will be negative 7.5%. So this is a much better presentation because we can actually common size, and there's a common base for all income outflows and inflows. So this is what I prefer, the second method for common sizing the cash flow statement. I hope everybody understand how the cash flow statement is common sized. And again, the benefits remain same for all common sizing. That is, it is easier to compare between different years for the same company, and it is easier to compare two different companies which are of vastly different sizes. For example, Facebook, the cash flow statement of Facebook has been presented where the values are in millions of dollars. For some other company, it might be in thousands of dollars. So there's a major difference. So even though the absolute values are majorly apart, yet because we are presenting it as a percentage, yet we can compare the two companies under common size statement. So this is how we common size cash flows. Next we come to a concept of free cash flows. Let me just confirm. We have not missed anything. Okay. So this is a new concept. This goes beyond the normal cash flow statement, and this is not compulsorily required to be presented. However, this is used for valuations by analysts. The valuations of using free cash flows will be present under the equity chapters under future levels. So not in level 1, level 2, level 3 you will be learning how you will be using free cash flows to calculate the value of a firm. But in level 1, what we will be understanding is how do we calculate free cash flow statement, free cash flows. Okay. So what is free cash flow? First, understand this. Free cash flows means the amount of free cash flows. There are two kinds of free cash flows. Free cash. Number one is FCFF or free cash flow to the firm, and number two is FCFE. That is free cash flow to equity. These are the two kind of free cash flows that are available to us. What is free cash flow to the firm? That is the money that is freely available for sending to the entire firm. What does the firm means? That means all types of investors. It can be borrow, it can be the lenders, and it can be the equity shareholders. Whereas free cash flow to equity means the cash flow that is available to be used by equity shareholders to the equity of the company. That is only the equity shareholders, that is freely available for use for the equity shareholders of the company. FCFF is the cash flow that is available to the company's suppliers of debt and equity, freely available for use for debt and equity. After the company has paid all its operating expenses and made the required investments, how do we calculate free cash flow to the firm? There are two methods. We need to, the first and foremost thing is need to see the starting point. The starting point in the first method. The starting point is net income. So we'll be starting from the same point, where we started the cash flow from operations from indirect method. So net income, which is the starting point for cash flow from operation from the indirect method, that is the same starting point for free cash flow to the firm. So CFO and FCFF have the same starting point. CFO is cash flow from operation from indirect method, and the free cash flow to the firm have the same starting point. Now, net income plus NCC is non-cash charges minus WCI or working capital investment. What does this give us? Think for a while. So these 3 points, that is net income plus non-cash expenses minus adjustments for current assets and current liabilities. What does this give us? Nothing but the cash flow from operations. So this is nothing but the cash flow from operations. So in working capital investment means adjustment for current asset and current liability, because working capital is nothing but current assets minus current liability. So in this formula it's written working capital investment, this is adjustments for current assets and current liabilities. So net income plus non-cash charges minus working capital investments, that is adjustments for current assets and current liabilities, using the same, absolutely same formulas. So if we simply add these three components, what will we get? Cash flow from operations, right? So we can write these three, we can remove these three options and we can write CFO, which is the second formula for FCFF. We can, in the exam, we can be given the starting point can be net income or the starting point can be CFO. We need to make sure, we need to remember that what is the starting point, or what we can instead do is, no matter what the starting point is, we will just remember the next formula. We will just remember the CFO formula. We'll just remember this formula, that is cash flow from operations plus two things which we'll learn about just now. But before that, we will forget this formula. We won't look at it. And to calculate FCFF, first we will calculate CFO. Our first step will be to calculate CFO or cash flow from operations. Okay. After we have calculated cash flow from operations, we need to make two more adjustments. What are two adjustments? The first is we need to add back the interest. Now, why is this? This is the free cash flow that is available to all the investors. So since interest is the payment made to the lenders or the debenture holders of the company, they are also a form of investor and they are also a part of the firm. So the money, the FCFF that we are calculating, that should be available to them as well. So that is why we need to add back interest, because that amount is available to use for the entire firm or including the lenders of the company. And why are we doing 1 minus tax? Because interest is a tax deductible component. So we are getting a tax benefit because interest helps reduce the income, which helps us to save taxes. Right? I hope everybody is understanding this point. So instead of adding the entire interest figure, we will do interest into 1 minus tax. That is, we will take into account the benefit of tax savings from interest. So again, I'm repeating this point if anybody is having any confusions, since while calculating net income, we have already reduced the tax component. If we add back the entire interest figure, that will be incorrect. Why? Because in case the lenders were not there, then that interest expense would also not have been there, and the tax benefit would not have been received by the company. So the net income of the company is higher because of the existence of those lenders and the interest component. Since the net income is higher because of the interest component, that is why while adding interest, will not take that into account, right? And after we do this, we will subtract all the investment into the fixed investments or the capital expenditures. Put this into account that this does not equals to the cash flow from investment. Cash flow from investing activity. This is not the same as that. We will just subtract all the capital expenditures to get the free cash flow to the firm. And finally, why do we not take into account anything from the final part or final component of the cash flow statement, that is the cash flow to financing activity? This is because cash flow to financing activity is all about the lenders and equity shareholders, and we are calculating the cash that is available to them. So we will not take into account any money that is coming or going from them. I hope everybody is clear here. Now coming to free cash flow to equity. We'll do a comprehensive sum in the end of the class, so do not worry, we will do a comprehensive sum and we will cover everything in that example. If you are having any doubts, you can get it clarified in that final sum, and if the doubt remains, you can give me a call. And next we come to free cash flow to equity. This is the free cash flow that is available just to the equity shareholders of the company, right? To the equity of the company. After the company has paid all operating expenses, borrowing cost, investment in fixed capital and working capital. So note, again, the starting point is very important. While calculating the free cash flow to the equity shareholders, what we will do is the starting point is cash flow from operations. So the cash flow from operations, in this case, what we will do after we start from cash flow from operations, we will subtract the fixed capital investment, which was again there in fixed cash flow to the firm. However, the adjustment for interest will not be there because that is something for the lenders of the company. So we will not add that back, and that will continue to be reduced. But after we have done that, and after we have reduced the fixed investments or the capital expenditures of the company, then what we will do is that we will add the net borrowing or subtract the net borrowing. What does this mean? If the company has borrowed money, if the company has taken additional debt, So that additional debt is something that is available in cash to the shareholders of the company. That is free cash flow that is available with the shareholders of the company. So hence we will say that cash flow from operations minus capital expenditures plus or minus the net borrowings. If we have taken money, then it will be positive. If we have repaid the net borrowing, that is we have repaid in net, then it will be a negative figure. A positive free cash flow to equity implies that the company has more operating cash flow than it needs to cover capital expenditures and the repayment of debt. Therefore, such a company has cash available for distribution to its shareholders. So a mature company, when we are looking in the financial statements of a mature company, we will expect the cash flow from the free cash flow to equity to be positive, because we will expect that the cash flow from operations is enough not only for future investments of for future capital investments, but the cash flow from operations is enough to repay the existing lenders of the company as well. I hope this point is also clear to everybody. So there are 2 points that we learned, that is free cash flow to the firm and free cash flow to equity. And finally, we move to the last segment, which includes the ratios. After we have done with the ratios, we will do a comprehensive sum. Okay, so let's start. As we have all learned that ratios are something that is very necessary for all financial statement analysts, as ratios help us to integrate every value into analysis points. This helps us to facilitate comparison between different time periods of the same company and facilitate comparison between two different companies. One of the most common ways to interpret and analyze the values of financial statements is to compare the ratios to the existing industry standards. For example, if I am evaluating the industry, if I am evaluating Tesla, I will be looking into the industry standard of other car companies and what is the ratios that other car companies are earning. I will look into the operating profit ratio, the cash flow to revenue ratio. I will be looking into the solvency and liquidity ratios of other car companies, and I will compare that to Tesla's ratios in order to determine whether the ratios are comparable. And if there are major discrepancies, I will want to know the reason for such discrepancies. It might be positive or it might be negative. The reason might be good or bad. So for cash flows, there are two types of ratios. One is the profitability ratios and other is the coverage ratios. Profitability ratios, as the name suggests, helps us to determine the profitability or the cash flows in relation to the profitability, whereas the coverage ratios help us to determine whether the company is earning enough cash to cover the debt of the company. Let us start with cash flow to revenue. So note that every point what we are doing is that the numerator is always cash flow from operations, except for the last one. When we'll get to that, we'll get to that. But in the first 4 profitability cash flow ratios, the top line is cash flow from operations. Why is that? Because we will only be able to compare the profits or revenue of the company with cash flow from operations. Investing and financing cash flows are not related to operations, and they might be significantly different from the actual identity of the company. If the company is earning, let's say, $100,000 in cash flow from operations, yet the company can borrow $1 million and invest that $1 million into new plant and machinery. But if we compare those $1 million to the revenue of the company, then it will not be fair. So what we do is that we will only be comparing the cash flow from operations to the net revenue to determine how much money, actual cash, is the company generating per unit of revenue. We want this figure to be somewhat similar to the net profit ratio. If the net profit ratio equals to 10%, we want our figure to be around 9 to to hover around 9 to 11%. We want cash flow to revenue 9 to 11%. If this is 10%, this is not any, I'm not suggesting any figure, but if the net profit is 10%, net profit percentage is 10%, then we want the cash flow to revenue percent to be 9 to 11%. We want it hovering around the net profit percentage. Coming to cash flow to assets, that is average total assets. So what is average total assets? Opening total asset plus closing total asset divided by 2. So average total assets is opening as total assets plus closing total assets divided by 2 of the company. So total assets during the beginning of the year, total assets plus during the closing of the year divided by 2. That gives us the average total assets of the company. So when we divide CFO divided by total average total assets of the company, this helps us to determine how much cash flows is the company being able to generate per rupee of assets that the company holds. This is something similar to return on asset or the return on investment. This is similar to that. I hope everybody is able to understand this, that cash flow to assets means the cash that the company is able to generate per rupee of per rupee of total assets that the company holds. Since this is similar to return on total assets, our next ratio will be similar to return on equity, since it is nothing but cash flow from operations divided by average total equity. Again, average total equity is opening total equity plus closing total equity divided by 2. So this helps us to determine how much cash flow is the company being able to generate per rupee of equity that the company has. Moving forward, this ratio is very important, because cash to income, this is something that we have already discussed in the previous slides also. We want the cash flow from operations to operating income to be as close to 1 as possible. Here they have taken operating income, instead we can take net income also. But we want this ratio to be as close to 1 as possible, because a ratio close to 1 will help us understand that the income that the company is generating, the company is able to collect money on that also. If it is significantly lower than 1, that means that the company is earning income, but they are not being able to realize cash flows from these customers. That means that the customers are not paying the company, so the customers might go bad debt. These sales that the company is making, they might not result in actual benefit to the company. Actual economic benefit might not be received by the company in future. So we want this ratio to be close to 1 or more than 1. The company should be able to earn operating profit. And finally, cash flow per share. This is similar to earnings per share. So we harped a lot on basic earnings per share, diluted earnings per share, but in this portion there is no diluted, everything is basic. So cash flow per share basically means cash flow from operations. Again, so minus preferred dividend. This was in BEPS also. How did we calculate BEPS? We did net income minus preferred dividends divided by weighted average number of common shares. In this, we are doing cash flow from operations minus preferred dividends divided by weighted average number of common shares. I hope everybody gets this ratio, and we do not have to go into the details of this, because this is very self-explanatory, and it is like yes. I hope everybody gets this one. Now let's move forward finally to our final segment of today's class, that is cash flow coverage ratios. So we learned that the profitability ratios of cash flows helps us to understand whether the company is earning cash flows in relation to the profits, and coverage ratios will help us to determine whether the company is able to earn cash flows which will help to repay the lenders and other borrowers of the company. So first, starting with debt coverage ratio. Again, see that we are only considering cash flow from operations, because cash flow from operations is the only thing that is the company is generating. Other than cash flow from operations, all the other money is not money that is that the company is generating from its operations. And when we are looking at ratios, we are judging the operations of the company. That is why we will always, whenever we are talking about ratios, the numerator will always be cash flow from operations only. So let's move to debt coverage ratio. Debt coverage ratio is cash flow from operations divided by total debt. So this means whether or not how much money, how much cash the company is earning per rupee of debt that the company has. This is very important for analyzing when we are giving money to a company, when we are lending money to a company. This will help us to understand whether the company is earning money per rupee of debt that the company already has. So if the company is not earning money per rupee of debt and this ratio is very low, then we won't be comfortable giving additional debt to the company. Next, interest coverage ratio. In this, we see that we are adding interest paid and taxes paid. Why are we doing that? Because interest is a pre-tax expense. So we will be paying interest before we pay the taxes, and interest is deductible on them. So while we take cash flow from operations, we will be adding back the interest that we have paid, and we'll be adding back all the taxes to determine how much money we have, how much cash flow we are earning to pay the interest that the company has, the interest expense that the company has. I hope that we all can follow. So cash flow from operations plus interest paid plus taxes paid divided by interest paid will give us the interest coverage ratio for cash flows. So cash flow interest coverage ratio. Next, we move to reinvestment ratio. Okay, this is not a minus sign, this is dash between these two, so do not get confused. So the reinvestment ratio is cash flow from operations divided by cash paid for long-term assets. So whether the company is earning enough cash flows from operations to make further investments, to make new investments into the company's future, into the property, plant and equipment of the company. So the company, we are doing cash flow from operations divided by the capital expenditure, the capex. This will help us understand whether the company is able to earn enough money to make new investments into the future of the company. We want every cash flow ratio to be as high as possible because we want cash flow from operations to be as high as possible, right? So every cash flow ratio needs to be as high as possible. The higher the ratio, the better. Except for which one? Except for cash to income. This is as close to 1 as better, right? We have explained everything why. Debt payment ratio is very similar to the first one. How much debt are we repaying and whether or not the company is earning cash flows from operation to repay the debt. These two will help us determine if they are high, that will help us to understand whether the company is repaying the debt and whether the company is buying new assets from its cash flow from operations or some other method. So if, let's say, reinvestment ratio is very low, it's close to 0, that means the company is not earning cash flow from operations to make new investments. So that will automatically mean that the company is using either its existing cash from previous years or the company is raising new capital, raising new debt to invest in the property, plant and equipment or the capex of the company. Similarly, debt repayment ratio, if it is close to 0 or negative, that will help us understand that the company is not earning enough cash flow from operations and the company is repaying the investors, repaying the debt or lenders of the company through sale of their fixed assets or through existing cash that was in the balance sheet of the company from previous years. We do not want that to happen and we want these ratios to be as high as possible. Next, we do cash flow from operations to dividend paid. This is simply the dividend. This is simply the cash that the company is earning per rupee of dividend that it is paying. And finally, investing and financing ratio, cash flow from operations divided by cash outflows from investing and financing activities. This is basically the summation of these two ratios, because in these two ratios we are dividing it by cash paid to long term assets and cash paid to long term debt. Those are most likely the total components of cash flow from investment and cash flow from financing. So we are helped to understand whether the company is earning enough cash flow from operations for its future expansion and for its financing to repay its debt and lenders. I hope all the ratios are clear to everybody. Now let us take a quick 10-minute break, and then when we'll get back, we will do a comprehensive cash flow statement sum. Then we'll do a sum. Okay, welcome back everybody. As you can see that I have started writing a sum. So we'll be doing this one sum in which we will have to calculate this and prepare the entire cash flow statement from indirect method. Please start copying the sum and we will understand every aspect of the cash flow statement once more as and when we are doing the sum. I hope every concept is clear relating to cash flow statements so that we can do the sum with ease. So what we are writing right now is the income statement of the company. The sales that I have written is nothing but the revenue of the company. Then we wrote down the different expenses. After we reduce the expenses, what we get is not the net income but the operating income of the company. Now when I'm writing this line, gain from sale of land, what does this tell us? That there is a sale of fixed assets which have taken place. Now sale of fixed assets comes under which head, which component? So that is cash flow from investing activity. Also, since we have not mentioned anything, we can calculate using direct method, indirect method both. But which method will be easier? Since we have to calculate the accruals anyways, direct method will be more difficult because we will need to calculate the cash flows from receipts, from payments individually. So it would be easier if we follow the indirect method. So that is what we will go with, right? However, if anybody wants to do this under the direct method, that is also correct and acceptable. Also note that the answer under both direct and method should always be the same. Just because we are following a different method, direct method or indirect method, that does not mean our answer can vary. The answer under direct and indirect should be the same, and if there is any discrepancy, that would indicate that there is some problem or there's some error that you have made. What does common dividend mean? Common dividend means the dividend paid to equity shareholders. Preference dividend is preference dividend is the dividend that we pay to the preference shareholders, and common dividends or dividend paid to the equity shareholders. So this is the entire income statement of the company. I hope everybody has written it down. Then we will write the balance sheet. So the total change in cash we can given. You see, we have to write both the years. If you remember that we need to take into account the changes in current assets and current liabilities. I hope everybody remembers everything that we have done today. This is a very important chapter and we expect at least one question from cash flow statements in the exam. I hope everybody can read. So cash is 33,000 and 9,500. Accounts receivables are 10,000 and 9,000. Inventory is 5,000 and 7,000. Then let us come to land. When we write about land, we will be writing 35,000 in the current year and 40,000 in the previous year. What does this tell us? Since there's a reduction, that means land has been sold. Next, gross plant and plant and machinery. This is gross figure. So this is before adjustment of depreciation. 85,000 plus 85,000 and 60,000. So what, there's an increment in machinery. What does this mean? That during the year there was purchase of machinery that took place. Less accumulated depreciation. This is 16,000 and this is 9,000. So net plant and machinery, PMN I am writing. Net plant and machinery comes to 69,000 and this comes to 51,000. And finally we also have goodwill. The goodwill is $10,000 in both years. See, there is no change in goodwill. However, if there was any change in goodwill, where would it have been presented? I want everybody to know where would goodwill have been presented had there been any goodwill. It would have been presented in cash flow from investing, because goodwill, accounting goodwill, as we learned about in the previous sessions, is recorded only in the books when it is as a result of acquisition of a new company. So acquisition means we are paying to buy a new company, and that is how the goodwill is arising in our balance sheet. Next we come to liabilities. Account payable or creditors. Wages payable. Wages are paid to our staff. 4,000, 8,000. Interest payable. This comes to 3. Taxes payable. Okay, also everybody remember those people who have done different courses. For example, if you have done CA, if you have done ACCA, if you are doing any different course, there might be certain differences. For example, if you have done chartered accountancy of India, then there might be different treatments, because that is as per the law prevailing in India. So the differences might only mostly will be relating to taxes only, because that is the only thing that is different. The rest, every cash flow is going to be the same. However, please do not follow whatever you have learned in any different classes or courses, because that is not going to help you. So we need to follow the method that I have taught in this class today, and that is the only thing that you are going to follow for your CFA exams. If you have any clarifications or queries, you can directly contact me. If you have taken the MEPL classes, my number will be shared with you. This figure is the total of current, na? Don't confuse. Then we come to non-current liabilities. That is common stock and earned. Since in the previous year it was higher, this means stock has been repurchased. Repurchase of stock is a positive or negative item for the cash flow statement. The negative item. I wrote equity. And last, but should have been in before equity, current liability. Deferred tax. So we are all done with everything that is there in this question. And I hope you all can see that this is a very, very detailed sum. And please start solving this sum on your own. If you have any queries, then you can look up on the board, but please try and not look up on the board till you do it by yourself. After you have done it, then try to copy the solution and we'll discuss it. So I'm writing the solution on the board, but please try it on yourself, by yourself, without looking on the board. And after I've written down the entire solution, then we will be discussing the solution. Okay, so I guess enough time has passed and let us look at the solution now. So we are doing the indirect method. So we started with net income, which was 37,000. Then we make adjustments for non-cash and non-operating activities. We make adjustment for non-cash and non-operating activities, right? What are the non-cash activities in this case? Depreciation and gain on sale of land is a cash activity, but it is a non-operating activity. It is relating to the investments of the company. Then we move to changes in working capital. We learned about every increase in current assets will be reduced and every decrease in current asset will be added. Conversely, every increase in current liability will be added and decrease in current liability will be reduced. So that is what we have already done in this place. Then we went to cash flow from investing activity to calculate the value of cash received from sale on land. What we did, we calculated the reduction in book value. So the change in book value was $5,000, right? $5,000. $40,000 was the opening value and $35,000 was the closing value of book value of land. So $5,000 is the change in book value, that is the book value sold, and 10,000 is the gain on sale of land. So total cash received was $15,000. So what we did, gross cost of land sold, that is 40,000 minus $35,000, plus the gain on sale of land, that is $10,000. Then we want to calculate the machinery purchase. In this sum, it is very simple because it is no complication. We have been given the gross values. In case we had not been given the gross values and we had only been given the net values, we would have to calculate the gross value through back calculation. But in this case, since we have been given the gross values, we will simply get the gross value of machinery purchase through a difference in the gross values of machinery purchase during the end of the year and the beginning of the year. Summation of those two will give us the total cash flow from investing activities. And finally, we go to the cash flow from financing activities, which is issuance of bonds and reacquisition of equity. These were the two activities relating to the financing of the company, right? Financing of the company. So issuance of bonds is something that will relate to money coming into the company, right? So since the closing value of bond is $15,000 and the opening value was $10,000, that means the company must have issued 5,000 fresh bonds. That will result into 5,000 additional dollars coming into the company. Then we move to reacquisition of shares. When we saw that the balance sheet had less equity shares as compared to the previous financial year, that means that the company has bought and reacquired some of its equity shares from the open market. That is $10,000 worth of shares have been reacquired, so it will be reduced. We have paid the equity shareholders money to repurchase the shares from them. And finally, last but not the least, we have paid dividend to the shareholders, equity shareholders. And how do we get the value of how much money has been paid to the shareholders? We will calculate beginning dividends payable, that is a liability in the books of accounts, plus the dividends that have been declared during the year minus the closing dividend payable. This is very similar to every other calculation of how to calculate cash sales, cash purchases. It is very similar to that, and I hope there is no confusion in relating to this as well. This will give us cash flow from financing activities. Now from this sum, we can also do our free cash flow to equity, free cash flow to the firm. It is very simple. Very simple. We can do that also. I hope you can do that in your homework. If you have any queries relating to calculation of free cash flow to equity and free cash flow to the firm, you can contact me. Now before ending, let us just go through everything that we have done today. Okay, so very quickly, let's start what we did today in LOS 20, understanding cash flow statements. First, we read about everything that the CF Institute wants us to know about cash flow statements. Now let us start. Components of cash flow statements. First is cash flow from operating activities. This provides the information about cash flows derived from a day-to-day operations of the company. Every cash flow that is relating to operations, it might be receipt from sales of services and products, it might be payment to employees, it might be payment for purchase of goods. Everything relating to operations is coming under cash flow from operations. Then we learned about cash flow from investments. This provides information on the cash flows that are derived from the purchase or sale of long-term assets and other investments of the company. Such ventures include the purchase or sale of property, plant, equipment, intangible assets, investments in debt and equity issued by other companies And finally, we learned about cash flow from financing activities. This provides information on the cash flows that are derived from acquiring or repaying capital. Anything that is relating to financing of the company. For example, we are issuing new bonds, we are borrowing new capital, we are raising new capital through issue of equity shares, we are reacquiring those equity from the open market to reduce the equity in our balance sheet. Everything related to financing of the company is coming under cash flow from financing of the company. Then we learned about non-cash investing and financing activities. There are certain items which are non-cash and are investing or financing activities. These will not be impacted. These are not considered, even though these are very important. For example, conversion of preference shares, conversion of bonds into equity. These are very important and will have an impact into the ratios of the company, into the capital of the company, but these will not be present in the cash flow statement. However, these might be separately stated in the footnote or the supplemental schedule to the cash flow statement. Then we learned about differences between IFRS and US GAAP. What we learned that there are 4 items. Number 1, interest received, interest paid, dividend received, dividend paid. For IFRS offers options of 2: operating for all and either investing or financing for all, but under US GAAP it is mandatory for interest received, interest paid and dividend received, interest received, interest paid and dividend received to be operating. US GAAP mandates in dividend paid to be financing, dividend paid to be financing. Now under IFRS, interest received can be operating or investing, interest paid can be operating or financing, dividend received can be operating or investing, and dividend paid can be operating or financing. This is what we learned. Then we get to income taxes. Under US GAAP, income tax is a mandatory operating activity. However, under IFRS, it is an option. We can either put it under operating or the impact of different items of taxes. For example, if there's a tax relating to sale of machinery, that will come under investing activity. For example, if there is any tax relating to financing activities such as dividend distributable tax, that can come under financing activity. So the tax relating to which item it is, it can go under that particular activity. That is how IFRS gives an option. Then bank overdraft has to be classified under cash and cash equivalent for IFRS. However, under US GAAP it has to be presented as a financing activity. It is a loan. Finally, there is no reconciliation statement required under IFRS. However, US GAAP requires mandatorily to present a reconciliation statement from the net income to the cash flow from operations, which is nothing but the indirect method of preparing the cash flow from operations. Then we learned about the linkage from cash flow statement and the balance sheet, how cash is presented in the balance sheet, and the different how we can calculate opening cash balance in the balance sheet plus the total changes, that is cash. So opening cash balance plus cash flow from operation plus cash flow from investing plus cash flow from financing will give us the closing cash balance. You can check this in the sum that we just did. Then we learned about direct method and indirect method. In direct method, we write all the line items where we will write cash flow, cash collection from customers, cash flow from suppliers. We will make adjustments of the accruals before we write the items, and we will write only the cash component. Then we learned about the indirect method, and indirect method we start with the net income, that is the last line item of the income statement, and we make adjustment for non-cash non-operating activities. Then we make adjustment for working capital investment, that is we make adjustment for all current assets and current liabilities. The increase in current assets will result in a decrease in the cash flow from operations, whereas a decrease in the cash flow, decrease in the current asset will realize a increase in the cash flow from operations. I'm really sorry. So current asset going up, CFO going down, current asset going down, CFO going up, current liability going up, CFO going up, current liability going down, CFO going down. This is what we learned. Then we learned about the methods of indirect method of calculating CFO. Then this is simply converting indirect method to direct method. This is nothing but the adjustments that we did in the indirect method and direct method. This is the same thing. Then we learned about investing cash flows. Investing cash flows, we learned about how we need to take into account all the investments that the company is making, the investment into property, plant and equipment, the investment into the shares and securities of different companies that the company is going to buy. If we are directly not given, then we can use this formula to calculate the cash flow from sale of equipment. Then we went into cash flow from financing activities. Financing activities, we learned about issue of new bonds, issue of new debentures, raising of new capital through issue of securities, or taking loan from banks or financial intermediaries. All those come under cash flow from financing activities. Then we learned about cash flow statement analysis. We learned about how we cannot just rely on the absolute values. We need to understand that cash flow from operations in a mature company, cash flow from operations should be positive, because since the company is mature, it should be earning profits, and the profit should be turning into cash. And cash flow from investing might be negative, which would be a good sign, given that the negative cash flow from investing is a result of investing into new property, plant and equipment of the company. Cash flow from financing again can be positive or negative depending on whether the company is repaying its lenders, or the company is raising new capital to invest into further property, plant and equipment. We need to check everything on a case to case basis, and we cannot just consider absolute values to make our judgment. Then we learned about how the net income and cash flow from operations are related, and we need to make sure that the cash flow from operations are close to the net income. If the cash flow from operations is much lower, that means that the company, even though the company is earning net income, yet the net income is not translating into cash flow, and the net income might never be translating into cash flow, and the debtors might turn bad, and this is a sign of poor earnings quality for the company. We learned about how investing cash flow should also be judged by the financial statement analyst. They should check into the sources of cash for major capital investment. If there is a major cash injection that is being taking place, whether the cash is coming from operations of the company, or whether the company is raising finance for putting the new investment. Even for financing, we should understand if we are repaying the borrowers and lenders of the company, whether the company is coming from the cash flow from operations, or whether or not the company is selling its current plant and property and equipment to repay its debtors. Then we learned about the common size analysis. There are two methods. One where the cash inflows are presented as a percentage of total cash inflows, and cash outflows are presented as a percentage of the total cash outflows, and which is not a very good method. However, the second method is good, where every line item of the cash flow statement is presented as a percentage of the net revenue of the company. Fine. Then we went to free cash flow to the firm. We learned about free cash flows refer to the cash flow available to the firm, which includes all the investors of the company, whether it be the lenders or the equity shareholders, where we will be starting from cash flow from operations. We will not look into the first formula, we'll look into the second formula. So cash flow from operations plus interest into 1 minus tax minus fixed capital investment or capital expenditure of the company. This will give us the total free cash flow that is available with the entire firm. And then we've moved on to free cash flow to equity, wherein we find the free cash flow which is available to the equity shareholders. This is after free cash flow to the firm. We remove the impact of interest and the borrowings to get FCFE. FCFE equals to cash flow from operations minus FCI, which is the same as the FCFF formula. However, we do not add back the interest. We let the interest be removed, and instead we add or subtract the net borrowings. If the company has taken new borrowings, that is new money that is available with the equity shareholders. If the company has repaid its borrowers, then that money will not be available in the hands of the equity shareholders. So FCFE is after FCFF, so CFO minus capital expenditure plus or minus net borrowings gives us FCFE. And finally, we went on to cash flow ratios. We learned about the profitability ratios and coverage ratios. Profitability ratios compares cash flow from operations only to various denominators, which can be net revenue, total assets, total equity, operating income, or weighted average number of common shares. The first four are simply comparing the cash flow from operations to various line items of the income statement or balance sheet, and tells us how much cash flow from operations is the company earning per rupee of those line items. And finally, the cash flow per share is similar to basic earnings per share, and gives us the cash flow that the company is earning towards its equity shareholders per unit of average equity shares in the company. And finally, we moved on to the coverage ratios, which helps us to determine how much cash flow the company is earning per unit of debt, per unit of long-term assets, or other line items of the balance sheet. So what are the line items that we'll be considering? First is the debt coverage ratio, that is cash flow from operations divided by total debt. Then the interest coverage ratio, which is cash flow from operations plus interest and taxes divided by interest paid. We learned about why interest and taxes are being added back. Then we learned about the reinvestment ratio, which is cash flow from operations divided by cash paid for long-term investments. Then debt payment ratio, which is cash flow from operations divided by cash long-term debt payment. Then final two is dividend payment ratio, is cash flow from operation divided by dividend paid. And the last but not the least, investing and financing ratio, that is cash flow from operations divided by cash outflows from investing and financing activities. That is all for today, guys. If you like the video that we are sharing on YouTube, and if you're learning something new, do like, share and subscribe to our channel. and please press the notification bars. It helps us, it motivates us to put more such videos on YouTube. Keep following MEPL classes. Thank you.